We are here in lovely Zurich, Switzerland with Guy Spier of Aquamarine Capital. It's a lovely day, Guy, but not all is well in Europe. What's going on?
You know, John, if the likes of you and I knew exactly what was going on, we would probably be able to invest a lot better. But, we all know the outlines of the crisis in Europe, and it's worth adding that Europe's a rich place, and Europe has, as an aggregate, has the assets to cover, has the resources to cover the liabilities, the debts that are outstanding in places like Spain, Italy, and Portugal, and Greece. But we do not have the decision-making ability, and we are seeing a crisis of decision-making ability. We have the German government and the state of Germany that has one approach, and by and large the rest of Europe, which has a different approach. The German approach is that you don't borrow more than you can afford to pay back, and if you can't afford to pay it back, then you need to engage in austerity measures to make it happen. And that works well in a country like Germany, where people by and large are sensible and are conservative in terms of the amounts that they spend, and estimate well what expenses will be, and always try to come in under budget and on time. In other countries where there's a slightly different attitude towards budgets, and there's a different attitude towards estimating budgets, people overrun. And the easiest solution when you've overrun is to print money, which is another kind of tax. But the European Central Bank does not have the power to print money, and Germany doesn't want to give it the power. So we have competing ways to solve the problem, and it seems like the only way we force a resolution of those competing ways is for there to be a crisis in the financial markets. And we know that the financial markets will test out any weakness. So as the financial markets, which are more powerful than any government, any individual, as the financial markets sense that this problem has not been solved, they test it. For example, by not showing up to issuance of bonds by the state of Italy, or issuance of bonds by the state of Spain. And at the end of the day, the financial markets are individuals like me and John and others who say, do I want to show up to an auction or not? And we always have the right not to show up, and people aren't showing up and will continue not showing up until the problem is solved. And if we just compare that to what happened in the United States in 2008, as Warren Buffett has said, you need to give the market, you need to show the market that you're willing to do whatever it takes. Whatever it takes means to bring the full force of all the state apparatus to solving the run on the bank or the liquidity crisis. What we had in 2008, and there's still political fallout to this day from it, is that we had the head of the Treasury, we had the President of the United States, and we had the head of the Federal Reserve, all three people showing up on television and in other places every day saying, we bring the full force of our institutions to deal with this problem. And in the case of the Federal Reserve, their balance sheet increased by, in the order of trillions of dollars. They saved multiple institutions per week. There's 1 week when it was a combination of AIG, Freddie and Fannie, and probably there's a bank or two that I've missed there. And that's really what we need. We don't need 100 billion or a trillion. We need clear buying power of $10 trillion and the willingness to act, and then it would be solved.
Why is the willingness not there? You talk about Germany having a different approach, and yet we know that politically Germany does have a very strong interest in keeping the EU together. So why is there this disconnect? Is it a populist sort of stream within Germany that the politicians have to play to, or is it something else?
I mean, first of all, we realize now, and we see, I mean, some people said it at the outset, the architecture, the decision-making architecture isn't there. They did not sit down when they designed the European Central Bank with the powers that it has. They did not ask themselves, what do we do in a massive liquidity crisis? They assumed that it wouldn't happen. So first of all, either the constitution of the bank, or there would actually have to be a vote to enable the European Central Bank to buy unlimited amounts of either bank or government debt. which they're not empowered to do. The Bank of England, for example, is empowered to do that. The Federal Reserve is empowered to do that. So first of all, we have just a limitation in terms of the decision-making ability at the central bank. And then we can go one step further and say, where is Germany? I mean, given the choice in the state of Germany between bailing them out by issuing lots of paper from the European Central Bank or finding another option, the state of Germany or the political system in the state of Germany hasn't decided what they want to do there. And they have not been faced with the stark choice. It's only when the crisis, when there's a painful aspect to the crisis, that decision-making is forced on the state of Germany. I think that specifically, in order for Angela Merkel to solve the problem, she would have to be willing to make a career-ending move. And it seems like she's not willing to do that.
Well, clearly, and this has been said, if something can't go on forever, it'll stop, and we will get to the final scene here, if you will. How is this going to play out? Ultimately, will the politicians cave and simply give the central bank the money printing power, and that's how we get out of this in Europe, or do you see a different scenario?
And you know what's amazing, John, about that question is that I think even the people who are on the inside don't know how it will play out, because the range of outcomes is so wide. And you could argue that Germany is playing a dangerous game if they want to hold the euro together. And the question is, so there are some people who very validly argue that ultimately between some kind of quantitative easing or change in the rules of the European Central Bank and the willingness of the countries that are not overly indebted to reach into their pockets, there will be a solution and all the countries will remain in the euro intact. There are some people who say there will be a two-speed, we'll go to two currency zones. There are some people who say that one or two countries will leave. And it really is just an open, we really don't know. And we have the crazy situation that even to the extent that people at the European Central Bank and the Council of Europe and the European Commission are working on the possibility of one or more currencies leaving the euro, they don't want to talk about it, because if they talk about it, then it would happen. So we have no idea how prepared they are for that. Because obviously if we're going to have one or two currencies leave the euro, it would be better for that to happen in an orderly and prepared fashion than in a disorderly and unprepared fashion. So that is a very long way of saying I have no idea how it's going to play out. And I don't think the smartest people on the planet know how it's going to play out. And it's a deep, deep failure of the architects of the euro that they did not put in the architecture in place, the decision-making architecture in place that everybody had signed up to enable there to be a response. So, for example, if the governor of the European Central Bank, in certain emergency circumstances, has the right to take out his pen and issue currency, I don't think that he has the right to do that. So even if the politicians go to Mario Draghi and say, we have to do this, he would say, I don't have the power, I'd be in violation of my power. Even if I signed it, the people who were to execute it would have to call me out and say, ultra-vires, you don't have the power to issue us this order. That is a deep failure, and I think that it's a reflection on the over-idealism. How can Europe claim to be the most civilized place on the planet and be so unbelievably idealistic when the history here shows that in human affairs the dumbest thing to do is to be idealistic, the thing to do is to be practical? I think that the answer that would be given was that if they went into the specifics of how this could fail and deal with it, then they may have not passed it in the first place. And so maybe it wasn't so much idealism as a desire to kind of not show the full story, because otherwise there would be too much opposition to it. And it's going to be very interesting to see how it plays out.
So, Guy, we don't know how this will play out, and you've stated it quite well there. Obviously, as value investors, we don't get to sit back and not play some of these holes, if you will, if you want to use a golf metaphor. What do we do today? Do we accept the uncertainty and look for individual values, or what's the approach to Europe?
I was deeply impressed by the recent interview that Warren Buffett gave on CNBC, in which he was asked, "Are you looking at any European banks?" And his answer was, "Well, we don't own any." And the way he answered it made it reasonably clear to me that he wasn't going there, because you just don't know exactly where the downside is and how far it'll go. The interesting thing is that I, as well as some other people, have loaded up on United States banks, and including Warren Buffett. And in the United States, we have, while the equity investors in the bank are never protected, the thing that we absolutely 100% know about the large money center banks in the United States is that they have a lender of last resort, and they have a lender of last resort. So the probability that an American bank is going to suffer from a sudden liquidity crisis because the markets, their short-term funders, do not show up for an auction is zero, I would argue, or next to zero, because the Federal Reserve would step in. So to the extent that American banks have been affected by fears in Europe, I think that's been a really interesting opportunity, because I think that the people who are afraid of them are not making the distinction between the European banks and the American banks. The fascinating thing is that John and I sit here and invest from a vantage point of Switzerland. Just because we happen to live here doesn't mean that we're invested here. The real question in Europe is, at what point do things get so bad that there are some really distinct values out there? I would share with you that based on it showing up in the Manual of Ideas, I took a much closer look at the Bank of Ireland, and I could not reach a level of comfort with the downside and did not see a high enough upside to convince me that I could go and invest my shareholders' money or my investors' money in Bank of Ireland. That just shows that I'm dumber or have less information available to me than was available to Prem Watsa and Wilbur Ross, who did invest in that situation. But it seems to me that the state of Ireland is much further along in their financial reforms. They've been taking their medicine as administered by the IMF much better, and it seems like there were certain assurances to some extent carried out and to some extent would be carried out in the future from the United Kingdom, which is a very, very close tie to not just to Northern Ireland but to the whole of the Irish economy, that they would not let things get worse than a certain amount in Ireland, and that may be part of their thesis. But that is part of, once, for example, if the European Central Bank were given the authority to be the lender of last resort, that would put a floor under a whole bunch of situations which would enable investors like us to come in. And because there's such uncertainty, it's hard to play. And that's part of what's causing the problem. And we don't have to play. We all sit on global pools of capital. There's China, there's Africa, there's North and South America, there's so many other places to put money. Why put money into a situation where there's not a clear floor?
Guy, perhaps looking at it a bit philosophically or stepping back a bit, even in the best of times when you analyze a bank, there's tremendous leverage on there. There are assets that an outsider really cannot appraise. So it is a black box no matter the times. And in a crisis scenario as we have in Europe today, that is obviously compounded. So do you just dismiss the banks out of hand, or do you try to look at, well, what kind of upside could I have on, let's say, a Bank of Ireland if things work out, and then try to come to some sort of conclusion on the expected return there?
Yeah, there's two things. First of all, I looked at the profitability of the Bank of Ireland before the financial crisis. So let's just assume that they get back to 2006, 2007 levels of profitability. What do they look like? And developed a sense of what kind of net income numbers they'd be showing, what kind of operating numbers they would be showing in such an environment, and maybe it's even slightly better than that. But let's just take that as the upside. And the upside, was at least a 2x, potentially a 3x. But if I remember right, I did not see a 4x, and I think that some of the US banks are potentially 4x's at this point. Just to give you Citigroup trading at $70 billion, it's not so long ago that it was trading at $300 billion. But the real issue is, when there's a run on the bank, when there's a liquidity crisis, when suddenly they can't fund their balance sheet, and every bank, every day, is relying on short-term funding, wholesale funding from the money markets. If the money markets don't show up, you could have your equity wiped up because of not a insolvency issue, but a liquidity issue. And so the real question is, what is the floor on that? Would they be able to pull through a liquidity issue? And nobody has any doubt that the Bank of Ireland, which still exists as an entity, even though all issuance of currency happens at the European Central Bank, has every interest in saving. The Central Bank of Ireland has every interest in saving a Bank of Ireland, but do they have the? They may not have the resources. The Bank of Ireland actually has assets of 20 billion euros. The Central Bank of Ireland has assets of 20 billion euros. How much of those would they be allowed to invest in the Bank of Ireland if in their short-term funding needs, if there was a run on the Bank of Ireland? It's not unlimited. What you need is unlimited funding ability. So
arguably, in the US, you have large banks like Bank of America with as much or more upside than a Bank of Ireland, let's say, or other European banks, and yet you feel like we do have more of the protection.
Because there's guaranteed short-term liquidity. If they cannot get it from the markets, they can get it from the Federal Reserve. And it's worth adding that in the United States, the popular backlash, even though various politicians keep trying to remind the American people that the US government has made money, the United States as a corporate entity has made money on their investments in banks, there is huge outrage. They feel like it's a bailout. And I don't remember exactly what week it was in the financial crisis of 2008. The Secretary of the Treasury, Secretary of the Federal Reserve, so it was Hank, what was his name? Hank Paulson, along with Ben Bernanke, basically called 10 large money center banks into a conference room at the Federal Reserve Bank of New York, called them out and said, you're taking $20 billion, you're taking $20 billion. Many of the banks complained and said that they didn't want it. And the US government took shares and warrants in the banks in return for that, just to make it absolutely clear. They went in one day, they put $300 or $400 billion, if I'm not mistaken, into those banks. They just said, here's the money, you've got it, we want the markets to see that you've got it. Unlimited amounts of money available to you. The European banks don't have that. If I have a run on the bank in Bank of Ireland might go under. And it's something else that is very badly done in the architecture, as I understand it, of the European Central Bank. If they have to save a bank, first of all, they can't issue unlimited funds. Does Banque Nationale de Paris, because France has more voting rights than Ireland, does that get favourable treatment? Does Deutsche Bank get favourable treatment because because Germany is 22% of the voting rights? Does it raise the possibility for political machinations in which banks to save and which banks not to save? That's all troubling, and a guy like me doesn't want to engage in political analysis. We want to engage in financial analysis. There's no question in my mind that a bank that's got America in its name, and given what the Federal Reserve demonstrated in 2008, is going to have its short-term liquidity funding needs met by the Federal Reserve as a lender of last resort. If the markets don't do it, we just don't have that in Europe. Big failing.
Clearly you and Warren Buffett seems like really differentiating between European banks and US banks based on that short-term funding ability. Yet you look at the valuations, and you have a Bank of America trading, last we checked, at about 2 times pre-tax, pre-provision earnings. What explains that? Why doesn't the market differentiate to the extent that you've just outlined?
Isn't it fascinating? Two economists are walking down the street. One has studied rational expectations. The other hasn't. The one says, look, there's a $100 bill on the floor. And the other one says, it's not a $100 bill because if it was, it wouldn't be there. One picks it up and makes $100. And the other one continues with his belief in efficient markets. And it seems to me that we have a massive, massive market inefficiency there. I think that probably, something that the likes of you and I, John, always forget is that we are such a minuscule part of the markets, and there are actors like state pension funds and sovereign wealth funds who have billions of dollars to invest in at a time. It's not unheard of for a sovereign wealth fund to have $20 billion to invest. And those people are subject to many of the same mood swings as market participants as a whole are. And it would not surprise me for a senior guy who's not well versed in financial analysis, who just says, the world's still in a financial crisis, stay away from financials. And they give that order across all financials, not just US financials, European, Asian, you name it. They just say don't do it. And so these vast pools of capital, based on somebody who's not familiar with the situation, are incapable of acting because, for example, they've given the overall policy decision not to invest in financials. And then sooner or later that will change. But meanwhile, we have Bank of America, as you rightly put, trading at 2 times pre-tax, pre-provision earnings.
And in the last quarter, as we've seen and we track super investor activity in the Manual of Ideas, Monish Pabrai has added a fairly large stake in Bank of America. We know that Bruce Berkowitz has owned it for some time. Buffett has added to his position in Wells Fargo. Lucadia has been adding to their stake in Jefferies. That stock has come down pretty dramatically on, again, fairly unsubstantiated rumors of exposure to Europe.
Yeah.
How would you rank this opportunity in U.S. financials right now if you take a scale that we had in the last crisis in late 2008?
I am blown away because it seems to me to be about as good as some of the best opportunities that were being offered during the financial crisis of 2008. And in my case, I was buying companies in Japan, and I was looking at other opportunities, and then this financial opportunity in the United States shows up, and I reallocated my investment dollars back towards the United States. So I think it ranks very, very high. I would add that I have a deep amount of respect for Lucadia, and I have a huge amount of respect for Jefferies Group. I have traded through them. They were the progenitors of a company called Investment Technology Group, which was an investment that at a certain period of time made a lot of money for me. And they were my custodian for a certain period of time. So I think that Jefferies Group is probably a phenomenal buy at the prices that it's traded down to. I make a distinction, though, between money center banks that cannot be allowed to fail by the Federal Reserve and smaller banks which could be allowed to fail by the Federal Reserve, and where, in the case of Jefferies, I would not want to bank on their ability to access the Federal Reserve discount window. You're more relying, I would argue, in their case, that Lucadia would back them up. And given the choice between having something that's cheap, that is backed up by Lucadia with all the greatest of respect, and having something that is cheap and is backed up by the Federal Reserve, I think I prefer the Federal Reserve. Because Lucadia has limited amounts of money, and the Federal Reserve, as I've bashed, as a point that I've made many times, is unlimited amounts of money.
And the willingness to use it.
And the willingness as demonstrated in 2008. And while we're at it, much as the public statements all say that they did the absolutely right thing in not saving Lehman Brothers, and it was important to show that a financial institution can fail, I think that if I had, and I haven't tested it, But I believe that if I had any one of the participants in that decision off the record and asked them, would you have let Lehman Brothers fail again? The answer would have been no, we would have not, because allowing Lehman Brothers to fail put an absolute, that worsened the financial crisis in a way that required them to act probably on a much greater scale if they would have saved Lehman Brothers, which does not mean saving the equity holders, doesn't mean saving the management, just means saving the creditors. I think that the financial crisis may have gone more smoothly. So I think that not only the willingness to act, but the absolute fear of God that if they were to allow even a moderately large financial institution to fail, it would create, we're not talking about major headache, we're talking about potentially risking a depression. So, yeah.
Once again, Guy, obviously as investors, we are paid to act and to make the right decisions for the long term. We're here in Europe. You've stated pretty succinctly why you prefer U.S. financial institutions to European ones, but other types of companies in Europe that have been unjustly sold off because of the crisis, but that perhaps have solid businesses that would continue no matter whether two countries leave the Eurozone or some other calamity happens here.
John, I'm absolutely certain that there are phenomenal businesses here in Europe that have been unjustly sold off, that will not be affected by the financial crisis, that at this point make phenomenal investments. And phenomenal for me is little to zero downside and at least a 3x or maybe even a 4x on the upside. And the question is whether I or you will get to it in time. And so far, I probably should be looking harder, but I have not found one yet that meets those criteria. But you never know. I may wake up tomorrow and find one. And there are ones that get rejected the whole time, and it's not hard to find ones that could go up 5x, but are also potential zeros. And it's not hard to find the ones that have got very good downside protection, but we don't expect, we would expect very moderate returns on the upside. The real question is to find both, and they're hard to find.
I know you also looked to the East for those kinds of bargains, specifically Japan, and Wilbur Ross has recently stated that he thinks the Japanese market is the cheapest and in a very long time at that. Can you tell us a little bit about how you approach a market like that?
As I stated in a recent investor presentation, then Japan's economy, we know that it's a very important part of the global system. We know that when the tsunami hit, many supply systems across the planet were affected by the slowdown in production. Many aspects of the motor industry were slowed down because suddenly parts that were being delivered from Japanese manufacturing plants could no longer be delivered. And it's not just the Japanese economy or what goes on in Japan locally. Japan is a mature economy. It has multinational corporations like Panasonic and Sony and Hitachi and a slew of others that are not such common names, which have a whole bunch of know-how that sits in Japan, and they have networks of factories and production facilities and research and development facilities across the planet that in one way or another are delivering wealth and income back to Japan. And so we should look at an economy like the Japanese economy very differently to the way we look at an economy that maybe is likely less developed and therefore has less integration and interconnections with the rest of the world. So it's a productive place. On top of that, it's a place with high social stability, with a hard-working, literate population, all of those good things. So, and we have a Nikkei average that is down by 75%. So if the Nikkei peaked at around $40,000 about 20 years, 40,000 points, not dollars, it was just an index of 40,000 about 20 years ago, is now at less than 10,000. So that's a dramatic decline. It's a 75% decline. It's trading a quarter of where it was. And, the statement to there are companies, small cap companies in Japan where you can buy the shares of the company at a discount to its market its market capitalization is at a discount to the cash on the balance sheet. So you're effectively, what you paid for the company is already sitting in cash on the balance sheet, and these are companies that have sustained earnings. They've had positive earnings for the last 5 years, and that's earnings that can be tested in that it's money that is clearly being added to the balance sheet or being paid out in dividends or being repurchased. And so in many ways, if I pay, you take the earnings engine and you give that a value, and you take the cash and you give that a value. There are companies that are very obviously easy 3x's from the price that one is paying for them. And so I think that's tremendous margin of safety and tremendous upside. Would argue, I think that the Bank of America was better because I offered more than 3x, and I felt just the same amount of downside protection. But I think it's very, very good. And I would add that the doom mongers in Japan, I respect their judgment, I respect their analysis, but I disagree with it. And first of all, the idea that suddenly when Japan has to borrow at 5% interest rates on global markets, Japan is going to go into a tailspin. There are many options that they will have once the Japanese population starts saving in a sufficient way that they can no longer fund their budget deficit through local savings. And one of them is to decrease social programs. There are various levers of government that I think that the people who are looking at financial doom in Japan are not paying attention to. I would also argue that a simple devaluation of the yen by 25 or 30%, I think, buys you an awful lot of what you need. And so, as a whole, the Japanese population may well become less rich by 25 to 30%, maybe a little bit more, maybe a little bit less. And in a certain sense, if I'm looking at a depreciation of the yen of 25 to 30%, that would act against my returns because I'm not hedged. But that is a much smaller number than the 2 or 3x return that I'm looking for. And when you have an economy that's borrowing in its own currency, it has just many alternatives that economies that do not borrow in their own currency don't have. So it's all a long way of saying that I think it's a very interesting opportunity, and I love the fact that very few people are looking at it. I also love the fact that Wilbur Ross announced that he was doing something there. I think he's one of the most astute and smart guys on the planet. He's also a guy that, based on the way I've followed him, he doesn't take flyers. The risks he takes are carefully calculated risks. He doesn't just say, oh, I think there's a lot of upside here, I'll try this out. So I would be willing to bid a lot of money to have lunch with Wilbur Ross and to pick his brain the way I had the opportunity to pick Warren Buffett's brain. I think he's perhaps one of the best investors out there today.
And as you say, Wilbur Ross, when he invests, it's usually with a fairly long-term thesis. One thing that long-term investors have lamented about Japan are the low returns on equity, because as your money stays invested for longer, your return comes down. Do you see any move in Japan toward better capital allocation so that returns on equity will come up as well and not just be cheap?
I don't have much to share for your viewers and readers, but what I would say is that as I started looking at these, sort of doing stock screens, much the way Joel Greenblatt would screen for stocks, using slightly different criteria but not much different to the magic formula. And I started seeing that there are, whereas 10 years ago I think it was relatively unheard of for a company to be a regular repurchase of its shares, there are now companies that repurchase their shares, and so that's an indication that there is a move towards better capital management. I'm not sure that it's happening within a time frame that would make a big impact on our returns. And in the case of a company that's trading at, they've got all this extra cash in the balance sheet, by and large, returns on equity are not going to look good. You're not buying it. You're buying it actually for the change that at some point somebody's going to take the cash and do something else with it. But I do see a slow movement in that direction. I think there'll be better managers of their capital in 20 years' time than there will today. That said, we know that in order for an investment to work out for an equity investor, given the kinds of discount rates we use, we really want to see something happening at latest within 10 years, but ideally within 5 years or less. And better capital allocation in Japan is happening over a 20-year period, so we could argue that it's static from our point of view.
Mm-hmm. And Sony might be a pretty good example of that. Howard Stringer is still there, even though the stock is trading very close to multi-year lows.
Yeah.
If you have a thesis that the yen should or will depreciate, do you look specifically at Japanese exporters, or are you just looking broadly in that market?
I mean, the first thing when companies that have their headquarters in Japan but have their revenues outside of Japan. And so that was a kind of an interesting way to do a first slice of the data. I think that what we found was that there were too many when you slice the data that way, you could get too many other things coming in there which are hard to sort through, so we ended up leaving that criterion aside and just going for companies that were absolutely cheap and not looking too closely, not using as the first selection criterion where they sell. And actually I would tell you that in the screens that I'm running now, that's still not a criterion. The criterion is how cheap is it. But yeah, that probably does make sense. In the case of Sony, it's quite interesting. I mean, some of us, probably not all of your viewers, will remember the Sony Walkman. The Sony Walkman was every bit as cool, if not more cool in its time, than anything that Apple has produced recently. I mean, this was really a marvel of miniaturization. It was the first time you could take portable music with you. And it's just an example of how it's probably best never to invest in large companies. I know one or two of the executives at Sony, and they're some of the smartest people of our generation, and deeply committed to Sony, deeply committed to making that company great as it was. But the institutional imperative takes over sooner or later, and it's very hard to compete when you're Sony and your founder has died. It's very hard to compete with a Apple where the Steve Jobs is still alive. Michael Bloomberg used to say about Reuters, he said, "My name's Michael Bloomberg. My name's on my company. I don't know where Mr. Reuters is, but he's not around today." It does make a big difference to have a dynamic founder behind you. That said, Sony is primarily a Japanese shareholder-owned corporation, and they recently, if I'm not mistaken, purchased parts of EMI. They have huge cash flows. They own a significant proportion of the world's music rights. And just think of that. X%, I don't know what it is, of the world's music rights are being paid to Sony, which then flows to their shareholders, which is sitting primarily even though they have a global shareholder base, the vast majority of their shareholders are Japanese institutions. So many other companies like Sony around the planet. Just in the automotive supply industry, there are multiple companies that supply components that they're the most competitive in the world. Many parts, many cars, majority of cars today have components that some of which are uniquely supplied from Japan.
Guy, talking about Sony or Apple and the impact that their founders have had on those companies, and how once those CEOs and visionaries are gone, you can see multi-year, multi-decade deterioration. How do you approach those kinds of technology-driven companies as an investor, looking at a research in motion that a few years ago was flying high with the BlackBerry and today is trading below book value?
Or I have a question for your viewers, and maybe a manual of ideas. Loyal readers and viewers can help me with this question. How does Warren Buffett, who's never invested in a technology stock in his life, end up buying IBM? And what analysis and what change? And so that, for me, was a very interesting question. That IBM, by the way, is as we all know, is the biggest purchase Berkshire Hathaway has ever made, all right, the company's grown. I think that the best I could do in understanding Warren Buffett's purchase of IBM is that in many ways it wasn't a technology buy, that technology has become a function within corporations much similar to the audit function or many other kinds of outsourcing that happen in corporations. And once you're already outsourcing to IBM, it's not so easy to change who you're outsourcing to, because IBM becomes deeply integrated into your organization, huge amounts of knowledge, huge amounts of switching costs, and so the argument is that actually it wasn't a technology buy. In terms of other purchases or other companies, we have this unfortunate factor which is called reversion to the mean, and the vast majority of companies eventually will revert back to the mean, and probably a good time for a company to revert back to the mean is when its founder is no longer around. And my inclination has been to just stay away. I would just add something that again I found fascinating from the recent CNBC interviews, that Buffett said that he specifically told Ted Wexler and Todd Coombs that they should not even consider buying Microsoft, because whether or not they had acted on any special insight gained through Buffett's friendship with Bill Gates, the marketplace would perceive that to be the case, which actually implied, I mean, he wasn't implying anything, but because I'm a Buffett watcher, we tend to read lots of things into this, and it's not inconsistent with the possibility that Buffett has looked at Microsoft and considered that it would be a good buy, but declined to make the buy because he did not want to have this perception. And Microsoft could have taken, I don't recall their market cap offhand, but it was large enough, or is large enough, that it could take a big investment from Berkshire Hathaway. But in general, and I guess it's worth adding that it's important to, in the case of IBM, if what I said is correct, Buffett didn't analyze it really as a technology stock. He analyzed it in terms of a company that is a provider of outsourced services to the Fortune 500 and more of the planet, where there's high switching costs. There are many cases, and maybe IBM is better thought of as a service provider that uses technology. And so we have to be careful about analyzing technology companies. Some companies with a technology, which are labeled technology, are not technology. That said, I've never even read an annual report for RIM, even though I have a BlackBerry and I'm addicted. Yeah.
Well, I think what you're saying about Buffett's purchase of IBM makes a lot of sense, especially if you interpret technology as the new thing. At one point in the 20th century, cars were technology when they first came out, or railroads were new technology, or airliners. And today, I think a lot of technology observers have started splitting the technology landscape into old tech and new tech. Yeah. Where in old tech you have companies like IBM and Microsoft and Cisco perhaps, and then you have in new tech all these social networking companies that a Buffett would probably never touch, and that have questionable durability of their competitive advantage.
And really forget about whether it's a technology company or not. Ask yourself two questions. If your customers, so put yourself into, you buy the shares of the company, you're now in that business, whether you're in the business of providing games to entertain middle-aged housewives as Zynga does, or whether you're in Facebook's business or in Google's business or in Microsoft, the railways. First question, how expensive would it be for the customer to switch away from you? What are the switching costs? Could they find a lower cost alternative? And, just to take an example of Zynga Games, my perception is that actually, if somebody comes along, Electronic Arts, and they provide some games, it's not actually that expensive. It might even be interesting for a client of Zynga Games who gives their attention to Zynga Games to go onto another gaming network. So I would argue that the switching costs there are very low. So the one question is, how sticky are you with your clients? The second question is, how does the fact that you already have a relationship with your clients give you high probability and high ROI reinvestment opportunities? So if I own a pipeline and people want to interconnect to my pipeline, gas pipeline, and people are growing either their demand for gas or supply of gas, I have some very high return, high probability, high ROI reinvestment opportunities. On the other hand, if I'm a driller for oil and I'm drilling in different fields, the fact that I hit pay dirt in one field doesn't mean that I will have any better chances in another field. The fact that now it could have within the field, so if I'm sitting on an unexploited large field where I've already had some finds, I now may evaluate that my reinvestment options are very high. But by and large, that kind of situation is less likely to give you high reinvestment options than a railway or a pipeline, especially if the railway or pipeline is sitting in an area of high growth in the particular activity. And probably in terms of that, you could argue that the distinction of technology is not the right distinction. The real distinction should be made in terms of stickiness, switching costs, and opportunities for high reinvestment, high rate of return reinvestment.
Guy, thank you very much for your time. This has been very insightful. We appreciate it.
Well, I should tell you that I'm sure all of your readers deeply appreciate the value that you bring to us. I think that the Manual of Ideas is one of the highest ROI opportunities for a manager of money, either his own or other people's, to spend money. It's extremely reasonably priced publication that is chock full of fantastic ideas and fantastic analysis. And I really think, John, that you provide a tremendous service to a whole bunch of people, and we should all be very grateful to you for providing it.
Guy, thank you for that unsolicited but much appreciated plug. As you know, John, I was plugging it before we became friends. So I'm not. You happen to be a friend, but I'm plugging it because it's a great thing to plug. It really is a tremendous publication. And on that note, Guy, have a wonderful day.
Thank you.